All right. So we are coming to look at IFRS 9, financial instruments. All right. So okay. All right. So you see that maybe as individuals, you see that you can have maybe some of us over here, we have treasury bills, okay, till bills in some of the banks. Okay. You can see that the till bills is a form of investment that we are having. Okay. The question is, this kind of investments, is it giving us any right to receive a cash flow at the end of a specific period or at a certain interval? Maybe the two bills that we are having is money that we are investing, that is a form of investment to us. But this particular investment, is it giving us any right? Do we have any right to cash flows at a given period or at a specific period of time? If that is the case, then this can be called a financial instrument. All right. There was a time ago that MTN was asking us to subscribe to their shares because they want to meet that particular 25 of the shareholding being subscribed to by the public. That is one of the listing requirements. They want to get listed on the stock exchange market. So they were sending out messages to the MTN mobile money that we should subscribe to their shares. The shares that you are purchasing, do you have the right to receive a contractual cash flow? Do you have the right to receive a cash flow at the end of every month, at the end of every year? Yes, you will be giving dividends at the end of every year. And you can see that the shares that MTN is giving out is something that if you buy, you become maybe part of the owners. So you buying the shares, you can classify that particular shares as financial instrument because it's something that you can invest in. It's an instrument that is tradable. Okay, so if you talk about financial instrument, we are talking about any instrument that is tradable, but that particular instrument will give you the right to receive a cash flow at the end of a given period. You should have the right to receive a cash flow from the investment. But any instrument that is tradable but does not come with a right to a cash flow at a given period, that particular instrument will not be classified as a financial instrument. So if you're buying treasury bills, do you have the right to receive a cash flow? Yes. You are going to receive an interest together with the principal. So that can be classified as a financial instrument. It's an instrument that is tradable. If you buy shares of a company, do you have the right to receive cash flow? Yes, you have the right to receive a cash flow at the end of every year or at the end of every month. This is dividends. So the shares can be classified as a financial instrument. If a company is issuing debentures and you purchase the debentures, do you have the right to any contractual cash flow? Yes, you are going to receive interest at the end of every year. And maybe after some period, the principal will be paid back to you. So the debentures will also be classified as a financial instrument. But let's come to Bitcoin. Let's come to Bitcoin. Okay. Let's come to Bitcoin. Okay. If you purchase a Bitcoin, do you have any right to annual or monthly cash flow from this particular investment? Bitcoin, do you have any right to monthly, annually cash flow from this particular investment? Yes, yes, Bitcoin.
Not to the best of my knowledge. I don't think they have such.
Okay, you consider Bitcoin is an investment that its value is based on what? Maybe the demand, the supply and demand of the market. So it will increase in value. But this particular investment is not going to give you any contractual cash flow at the end of every month. You don't have the right to receive any cash flow from this investment. So the value will just be there and be increasing. Nobody's going to pay you interest on this. Nobody's going to give you send you an amount of money into your account. So Bitcoin cannot be classified as a financial instrument, but rather we can classify it as maybe intangible assets. So any instrument that is tradable, but that particular instrument that is going to give you a right to a cash flow, is giving you a contractual right to cash flow. You have the right to receive an interest or dividend on that particular investment. That's what we call the financial instrument. So with this, we can say that shares, debentures, or debt instruments are all financial instruments, because investment in any of these items is going to give you a right to receive a contractual cash flow at the end of a specific period of time. All right. But the issue now is, if you are a company that you are issuing, you are a company A, that is issuing debentures. So issuing debentures to the public. Okay. So, and the public, we can assume that is company B, and company A is issuing debentures. You are going to receive money. Okay. This particular financial instrument, how will company A be showing this financial instrument in its financial statement, specifically the statement of financial position? Okay. So debentures, you are issuing the debentures and people have subscribed to the debentures. How are you going to report this? Assuming you have issued this for 30,000 and the people have purchased all the 30,000. What will be the double entry for this particular transaction? Company A issued the debentures up to the value of 30,000, and this has been bought by the holders. What will be the double entry at the date of this transaction?
Hello. Linus.
Yes, yeah.
So A will be recording financial liability, and then B will record financial asset. The reason being that like B, which is buying the debentures. Hello.
Yeah, I can hear you now.
The B is buying the thing, the debentures from A. So A is supposed to pay B.
Okay.
Therefore, A will be recording the transaction as a financial liability, and B will be recording financial asset.
Okay, thank you. All right. Then my question is, what will be the double entry in the books of A at the date of transaction? We debit what?
You debit cash.
We debit cash or what? Bank 30,000. Then we credit.
Long-term liability.
Okay, debentures, which is a financial liability. Okay, 30,000. So the debentures that we have will be called a financial liability, or you can still make it the debentures. But under the IFRS 9 financial instrument, the debentures will be classified as a financial liability. It's a liability because A has a financial obligation to fulfill towards B. But what will happen is that B, the double entry in the books of B will be debiting the debentures, which is a financial asset because they are buying and they will be crediting their cash or bank. Okay, so this will be 30,000, which will be financial assets. And this will be the cash or bank, 30,000. All right. All right. So we have the IS-30T, which is a presentation and a classification of financial instruments. So financial instruments can be classified as a financial liability or financial asset, depending on the person's or depending on whose statement or whose books you are going to do the entry. So if you are doing the entry in the books of the issuer is receiving cash, and as a result, they have a financial obligation to perform to the person that they are receiving the cash from. It's just like you are borrowing money from someone. So you are owing the person. So the issuer is going to classify the instrument as a financial liability. But the buyer is now giving money out for a certain item. So your money is with someone, that will be a financial asset to you. So the buyer is going to classify the instrument as a financial asset. All right. So we are going to take them one by one. We look at the financial liability. Financial liability is just like any normal liability. Okay, so financial liability is like any normal liability. Okay, if you come to liability, what are the two classifications of liability? What are the two classifications of liability?
We have the short term and the long term.
So we have the current liability. We have the non-current liability. Okay. The short-term liability, they are supposed to be settled within a year, isn't it? All right. So to be settled within a year, and this one may be more than a year. The same way, the classification of financial liability is done between the non-current and then the current, but just that we don't call it current liability and non-current liability. So how the financial liability are being classified like this. So the first one is financial liability or financial instruments classified or designated through profit or loss. So classified or designated through profit or loss. Through profit or loss. So this one is a current liability. So you see financial assets or financial liability or financial instrument classified through profit or loss is the current liability. Then you see the second one, which is a non-current liability, will be the financial instrument or financial liability non-classified through profit or loss. That is the non-current liability. So financial liability or financial instrument or liability not classified through profit or loss, and that is a non-current liability. All right. The question is, how will you know that this is a financial liability classified through profit or loss? We always use the duration to determine it. Or the question will say that this instrument is being held for speculative purposes. Or this instrument is being held for what? Trading purposes. So if they are saying that it's being held for trading purposes, it means that the instrument can be disposed of within a shortest period of time or within a year. All right. So mostly we use the duration to determine whether it can be classified through profit or loss, or it will not be classified through profit or loss. So the question will say that ABC Limited has issued a 4-year debenture. So it means that a 4-year, it will take 4 years for the debenture to be paid back. So it means that that will be a long-term liability. So they can say they have issued a 6 months. That will be a current liability. So sometimes you have to use the duration to determine how the instrument will be classified. How the instrument will be classified. All right. Another thing that I want to talk about is sometimes they can give you certain instruments. The instrument can either be classified as a debt instrument or equity instrument. So sometimes they will give you a certain instrument. You have to decide whether it is an equity instrument or a debt instrument. Example, preference shares. We are saying that equity instrument is those instruments that is going to give the holder part of what? Ownership. It's going to give you ownership. But if you come to preference shares does not give ownership. So preference shares are treated as debt instruments. Preference shares are treated as debt instruments. Sometimes a question can say that the preference shares, this and this, this and that. No. As far as the preference shares are not going to give ownership, we can have cumulative preference shares. For equity shares, whether profit is made or not, if profit is not made, the company might not be able to declare dividends. But for preference shares, which is cumulative, if profit is not made, you are going to defer the dividends and pay maybe in the future. So you have to suggest the instrument to the characteristics of what? Equity instrument. If the instrument meets the characteristics or the criteria for classifying an instrument as an equity instrument, then that will be classified as an equity instrument. So the instrument can either be classified as equity instrument or debt instrument. So you can be giving certain instruments in the question. You have to determine whether it will be a debt instrument or equity instrument, looking at the characteristics of debt instrument and also the equity instrument. All right. Let's now come to the instrument that will be classified as current liability. Let's talk about the first one. Okay. So financial liability classified through profits or loss. Through profits or loss. Okay. All right, let's look at this one. Okay. If you are going to buy, maybe if you are going to issue, or let's assume that if you are a company that you are going to issue debentures. Okay, you are going to issue debentures. Issue of debentures. Do you think that there is certain cost that we can incur, which is associated with the issuance of the debentures? Is there any cost that a company is going to incur as a result of what? Issuing the debentures? Is there any cost that will be associated with the what? With the issuing of the debentures? If the company wants to issue the debentures, is the company going to incur any cost? Any cost as a result of what? The issuance of the debentures? Do you think there's any cost that you are going to incur?
Yes, sir.
Yeah. Okay. What are those costs?
Anyway, they classify it as issuing costs.
Okay. So any cost that will be, so they can incur issuing costs. Or say, what is the example of this issue cost? Issuing cost. Can you give us any example? Okay. So the thing is, all right, we can
give discount to
okay. The discount can also be maybe the discount you are giving a discount as a result of the issue, the issuing. So we can also classify the discount as an issuing cost, no problem. because you wouldn't have incurred the discounts if you are not issuing the debentures. Okay. But another one is maybe your debt instruments are not listed. So before you can get it listed, it means that you have to do certain things. You have to go and pay for the listing, which can also be classified as an issuing cost. But if your debentures are listed already on the stock exchange market, it means that if you want people to be aware of this particular instrument, you are going to do advertisements. You're going to do advertisement for this particular instrument. So you can decide to do the publication in the national newspaper. They are going to charge you. They are going to charge you. So that particular cost will be an issuing cost. You can also decide to issue the instrument through people that we call underwriters. Give the instrument to them that they should find buyer for you. So we also have what we call the underwriting cost. All of this is classified as a transaction cost. Any cost that you are going to incur directly as a result of what the issuing of the instrument, they are all classified as a transaction cost. All right. So let's assume that the cost of the instrument, the debenture that you are issuing, is 30,000 US dollars. Okay. And you have engaged people. Some people should go and look for the buyers for you. So you are going to pay them maybe agent fee or commission or something like that. Okay. So the commission, let's assume that the commission is 2,000 US dollars. Okay. All right. Let's come here. How are we classifying the instrument? The instrument is being classified as a what? As a current liability. The meaning is that the instrument will be what? Will be disposed of within what? A year. So if the instrument will be disposed of within a year, it means that the commission or the transaction cost should also be consumed within what? A year. So if it is going to be consumed within a year, what do? We charge it to profit or loss. So it means that the commission is going to be consumed within a year. If it is consumed within a year, it means that it must be charged to profit or loss, because we charge items that are for the year. So profit or loss, statement of profit or loss for the year ended. So those activities that happen during the year and they are of revenue nature, we charge them. So the commission that we are incurring, maybe we have done the issuance on January 1 and we are preparing our financial statement on December. It means that the commission, which is incurred on the debenture, which is going to be disposed within a year, the commission will also be consumed within a year, which is January to what? To December. Therefore, the commission should be charged to profit or loss because it will be consumed over the period of the instruments. That is just a year. All right. So what we do is that we are going to have our debenture as 30,000. Then the commission of 2,000 will be charged to profit or loss because this commission will be consumed within a year and we're preparing the trading profit within the year. All right. But the question is, if this issuance should be done on July 1, if this issuance to be done on July 1, and we are preparing our financial statement on December, it means that our year is only 6 months. We have issued this one 6 months to the end of the year. What will happen over here is that for the commission, what we do is that we are going to charge only 1,000. It means that the commission will be consumed over a year, but for this particular year, it's only 6 months. So we divide the commission by 2 and charge only 1,000 to profit or loss, and send the remaining one to profit or loss. Statement of financial position as a deferred what? Expense. All right. But if the issuance is done at the beginning of the year, it means that the commission will also be full of the commission will be charged to profit or loss because it will be consumed over a year because of the classification of the instruments. Because of the classification of the instruments. So it is for this reason why transaction costs associated with what? Financial instrument or financial liability classified through profit or loss is expense, straightforward. Because the instrument is going to be consumed within a year, it means that the expense will also be consumed within a year. Therefore, the total expenses should be charged to profit or loss. That is very simple. All right, let's assume that this particular instrument is issued at a discount of 10%. So if it is issued at a discount of 10%, the meaning is that we are going to have a discount. We are going to have a discount of 3,000. The question is, should we subtract a discount from the 30,000 and have 27,000, or what do we do? What do you think we are going to do based on understanding of the commission? Okay, the explanation given to the commission. The explanation given to the commission. What do we do to the discounts? Do we subtract the discount of 30,000, or what do we do? Yeah. Yeah.
So since the discount is for one period, that is for 1 year, then we expense the discounts in the P&L.
That is all.
We will not subtract from the 30,000.
Okay.
Yeah.
So, yeah, that is, thank you. That is
if
all.
it is for 6 months for the 4, maybe. You said?
Yeah, I said that is all. So thank you. Oh, you have something to add? Gina, do you have something to add?
Sir,
Yes, Gina.
Hello.
please, are we saying
Hello.
that
Yes,
the
Sapato, can
question
you hear
is
me?
the discount is on the 300,000, right?
It's okay.
We are relating it to the 300,000, whether we subtract it or not.
Yes, please.
We have to take it out because it's like we are going for a loan at the bank. They
Okay.
will deduct all those expenses and give you the. Assuming you apply for a loan of assuming you apply for a loan of 10,000.
Okay.
They will take some commission. They will take some expenses out of it. You don't get the exact amount. So I'm relating it to this one. That they will take out the discount from the money before they give you the next.
Okay. That is if you are going to, let's assume that you are going to pay the loan within a year. The loan that you are going to take might be more than a year, but we are talking about the loan that will be paid within a year.
Okay.
Okay. So the loan that you are going to pay within a year, within that particular year, you are going to pay the 30,000, isn't it? Within a year, we are going to pay the 30,000, isn't it?
Yes.
Okay. If you are paying the 13,000, what will happen is that the bank is giving you 27,000. Let's assume that the bank is giving you 27,000 because of some certain expenses. But at the end of the day, you are going to pay all the 30,000. Okay. But what we are saying is that just have your liability as 30,000 and charge those expenses that is amounting to 3,000 as profit or loss, because the loan will be paid within a year and those expenses will also be consumed within a year. It's an expense to you that you have to charge to profit or loss. But the issue is, how many years are you going to pay this amount of money? It's just a year. It means that the expense will also be spread over the year.
Okay.
Okay, that is why we are charging all those expenses relating to financial liability classified through profit or loss. The treatment of the expenses depend on the duration of the instrument itself. So if you purchase an asset that is going to be consumed over a year and you incur a cost, it means that the cost will also be consumed within that year. You can't spread the cost over 5 years. Spreading the cost will be determined on the useful life of the assets. That is why we add direct cost to assets, because we assume that the installation cost that we are paying will be consumed over the useful life of the asset. That is why installation cost is added to the initial cost of the asset. But assuming the asset is just for a year, the installation cost will just be expense for that particular year, because the installation cost, the asset is for 1 year. the installation cost will also be for 1 year because the installation cost is relating to the assets. So the treatment of the transaction cost and the discount depends on the useful life of the assets or the liability. So that this liability is just for a year. It means that any expense that is going to be arising from this particular liability must also be what consumed over a year. So if you come to financial liability that are classified through profit or loss, any transaction cost should be expensed because the transaction cost will also be consumed within a year. Any discounts relating to that particular instrument should also be what? Expensed. All right. So it is for this reason that transaction costs, discount, and those who are associated with financial liability classified to profit or loss are being expensed to profits or loss. Straightforward. All right. Let's come to the 2, which is the financial liability not classified to profit or loss. Financial liability not classified to profit or loss. Okay. So let's assume that the debentures are 4 years. The debentures are 4 years. We are going to issue them for 4 years. So it will take us 4 years before we can pay the debentures back. All right. So the issue is we are issuing a 4-year-old debenture for 30,000. Okay, let's assume that the commission is also 2,000 and the discount is also 3,000. Okay, so the debenture is 4 years. It means that the commission should also be what? The commission is relating to what? To the debenture. So should we expense the commission to profit or loss in that particular year, or what do we do? What would be the best or what would be the appropriate what treatment of the commission and discounts?
Hello.
Yes, yeah.
So this one is not for 1 year. So
Okay.
what we do is that the commission and the discount should be capitalized. By capitalizing a liability, you deduct it from you deduct the 2,000 from the 30,000 to get 28,000. And same to the discount too. You deduct the discount too from the 30,000.
Okay. Thank you. Thank you very much. All right. All right. So the instrument itself is 4 years. Okay. Since the instrument is 4 years, it means that any expense, any direct expense that is relating to the instrument should also be spread over what? Over 4 years. So the meaning is that if you want to charge your commission to profit or loss, every year will be 2,000 divided by 4 because the commission is relating to an instrument that is going to last for 4 years. So it means that the cost must also be spread over 4 years. The discount is also an expense. That will be 3,000 over 4. So every year we charge. Then you also count the interest on the what? On the debenture, which will also be charged to profit or loss. So this is how we're supposed to what? Treat the transaction cost and also the discount. It must be spread over the useful life of or the maturity period of the instruments. All right. But what do we do? You see, they can give you that the interest rate for this particular one, they will give you that the financial instrument carry a coupon interest of 5%. Okay. So this 5% is a coupon rate, which is the actual interest rate for the what? For the debenture. But the question will give you something that we call effective interest rate. So they will give you maybe effective interest rate of 7%. You see, the effective interest rate that they are giving to you is considering the impact of the transaction cost and also the discount. So let's take this one by one. What will be the commission every year? And let's come to the interest on a debenture. Okay, let me show you something. Interest. What will be the commission charge every year?
500.
500. Okay. So this will be what? 750.
Yes.
Okay. Let's count to the interest on this one. The interest will be 5/100 times 30,000. I'm getting 1,500, isn't it?
Yeah.
All right. So it means that the profit or loss in the profit or loss account of the company is supposed to have a commission of 500 as an expense, discount also of 750, and the interest on the debenture as 1,005. So in all, they are going to be having 2,750. Okay. But what they will do is that they are going to give you an interest rate in the question, which is what we call the effective interest rate. That effective interest rate is going to take into consideration the 1,005, the 750, and the 500. It's going to take into consideration the 1,005, 750, and 500. So what you have to do is that you don't have to amortize the commission, the discount, and this one over 4 years. Again, what you do is that we call something capitalizing the transaction cost or the discount. All right, let's come here. If you come to the debenture is a liability. So let's come to debenture account. Debenture account will be debenture accounts. This will be cash. This will be cash, which will be 30,000. Okay, these are direct what? Expenses. The commission and the discount are direct expenses. They are costs that we have to incur to sell the what? To sell the debenture. So it means that they have to be capitalized over the what? The useful life or the maturity period of the debenture. Okay, let's come here. Commission is an expense, isn't it? Commission is an expense. Okay, so if you are opening commission accounts, it means that you are going to be having cash here and you are going to have 2,000. But we don't want to open the commission accounts. We want to do this entry in the debenture account because we are capitalizing it. So what will happen is that you count the debenture account, then you have commission to be what? 2,000. You have discount to, discount is an expense. You have discount to be 3,000. It means that at the end of the day, your balance carried down will be 15,000. Okay. All right. So this means that you capitalizing your direct expenses will mean that you should subtract them from what? From the debenture. So you have to determine the fair value of the debenture, which will be, maybe you have the nominal value of the debenture should be 3,000, should be 30,000. Then you now classified or you now capitalize the commission. Capitalizing means you are subtracting. Okay. Then you now come to the discount. The discount to capitalizing means you are subtracting. So you have 3,000. So this will now give you 25,000. So this is now be the face value. Okay. You have to be aware that for each year, the figure that you have to charge to profit or loss will be 500 for the commission, 750, and also 1,500 for the interest. So the question will give you an effective interest rate. Okay, the effective interest rate will always be higher than what? Than the nominal rate because of the impact of the transaction cost or the direct cost on the instrument. So we have to charge 500, 750, and 1,005 to profit or loss. Now you are subtracting these figures. It means that we need to get a percentage which will be higher so that if we apply it on this particular net figure, it will be higher than the normal interest. So they can give you 7% or 8% as the effective interest rate. Let's calculate 8% on this one. Let's calculate 8% on that particular figure. That will give you 0.08 times 25,000. What are we getting?
2,000.
Okay, so this will be 2,000. You see, this 2,000, 1,005 out of it is for the normal interest. But the 500 over there is for the debenture, is for the commission, and then the what? The discounts. Okay, if you are giving the effective interest rate, at the end of the day, the calculation that you are going to do will be up to the 2,000 and also the 3,000. But the manner that you are going to consume the direct cost will not be the same as if you want to amortize it. But you can see that this is giving you a value which is higher than the normal interest. The excess of the interest is for the amortization of the direct cost. So what we do is that after getting this one, what do we do? After getting this one, what do we do? Okay, we calculate the finance cost, which is the impact of the this plus this plus this. That will give you the finance cost. Okay, assuming you are amortizing these figures, it means that at the end of the year, your interest, your debenture will be 30,000. Then you add your interest of 1,005. Then you are going to pay the 1,005 at the end of the year. So this will give you still 30,000 every year. But since you are now adding the direct cost to this one, it means that you are not going to be having 30,000. That is why at the end of every year, you have a coupon of the normal interest. It means that if you are carrying the instrument alone, you add your interest, then you subtract the interest payment because you are paying the interest at the end of every year. That is why we subtract the coupon from this one. Then you now have your 25,500. That's how we do it. So this is for the financial liability not classified for profit or loss. All right. So this is what we call the amortized cost. So you carry this one through amortized cost. What do we call the amortized cost? At the end of the year, you add your interest to the amount that you are owing. Then you subtract the amount that you are paying, which is always the coupon. That is all. Let's pick a question so that we move on. Today we are going to do only financial liability because of yesterday. Okay, so the time cannot go like that, so I have to do the financial liability today so that maybe next week we do the financial assets. So let's pick this question on okay, before we pick a question, let me talk about this one. Okay, if the instrument is issued at a discount, if the instrument is issued at a discount or there is a transaction cost, mostly the effective interest rate will be higher than the normal interest rate on the what? On the instrument. Okay. But if you are not giving effective interest rate, assuming the question that we have solved, the debenture was 30,000. Okay, discount was 3,000 and commission was 2,000. Assuming the question did not give you effective interest rate. Effective interest rate is the interest rate after considering the impact of the transaction cost and other items on the gross amount. So it means that if you are giving effective interest rate, they have now considered the impact of the transaction cost and the discount on the amount. So they have given you an interest rate that is going to give you the interest that you should be charging every year to profit or loss, and also the amortization of the transaction cost and the discounts. But if you are not giving effective interest rate in the question, this is what you are going to do. If you're not giving the effective interest rate in the question, don't subtract the discount and also the commission from the debenture. Because if you are subtracting it, it means that you want to use a rate that's higher. That will give you the impact of the amortization of the discounts and also the commission cost after subtracting from the gross amount. But if you're not giving the effective interest rate, you still carry your debenture at 30,000. Then you charge interest of 1,005 every year. What will happen is that you capitalize the discounts and also the commission and amortize them over 4 years. That will be 750 and 500. You only subtract the commission and the discount from the gross amount when you are giving effective interest rates. So if you are giving the effective interest rate, it means that the effective interest rate will give you the 1,005 and also the amortization figure. But if you're not giving effective interest rate, you carry the debenture at 30,000, charge your normal interest of 1,005, and you amortize your discounts and then the commission over 4 years and charge their amortization every year to profit or loss. But mostly the question will give you the effective interest rate. So you have to capitalize the transaction cost and the discounts. Okay. What you have to know is that if there is a transaction cost and also there is a discount, the effective interest rate will always be higher than the normal nominal rate. Okay. The same way, the instrument can be issued at a premium. You can see that we are issuing at a discount. The same way the instrument can be issued at a premium. If the instrument is issued at a premium, you say the premium is an income, which will be what? Spread over the what? Over the maturity period of the instrument. So if you want to amortize a premium, what are we going to do? Are we subtracting what we are adding? A premium. The instrument is issued at a premium. What are we going to do? If the instrument is issued at a premium, with the premium, are we going to be subtracting or we are going to be adding to the instruments, to the value of the instruments?
We add to the value of the
Okay.
instrument.
Okay. So it's the opposite of the discount. Discount is an expense. That is why we are subtracting it from liability. The premium is an income. So it's going to be having a credit what? Balance. So we add it to the liability because the income and then the liability are always, the two of them are having a credit balance. All right, that is fine. So let's pick a question on that. So I just want to draw your attention to that. And if there is a premium, the discount rate or the effective interest rate will always be lower than the what? The nominal rate. All right. Let's pick the question 1 and then the question 3 so that we close. Okay, someone should read the question 1 for us.
Senior PLC Senior issued 4 million cumulative redeemable preference shares on 1st April 2020 at their nominal value of 1 cedi each. The shares carry a fixed dividend rate of 6%, which is payable annually in arrears. They are redeemable on 31st March 2024 at a premium of 300,000. Senior incurred a transaction cost on 1st April 2020 of 1% of the issue proceeds. The effective interest rate associated with the shares is approximately 7.9%. Required in line with IAS 32 financial instrument presentation, IFRS 9 financial instrument, set out and discard the accounting treatment of the above issued shares within Senior's financial statement for the year ended 1st March 2021.
Okay. So this is a cumulative preference shares on 1st April. Okay. Is this a debt instrument? How would Senior be classifying this particular instrument?
It's a debt instrument.
Okay, this will be classified as a financial liability, not through profit or loss, because of the what? The maturity period is 4 years, isn't it?
Yeah.
All right. So the classification, the 32 only talks about the classification or the presentation. How will it be presented? It is a debt instrument that will be presented as a financial liability, not through profit or loss, because this is going to be there for 4 years. All right, let's come. So what I will do is that I'll do it for 2 years. So question 1, Senior PLC. Okay. So let's talk about the nominal value of the instruments. What is the nominal value of the instruments?
4 million.
4 million. Okay. Okay. So they are issued at 1 cedi. So that will be 4 million. Okay. So we have 4 million. What is the transaction cost? The transaction cost is the issue cost. It's 1%, isn't it?
Yeah.
So 0.01 times 4 million. We are going to have 0.04 million. Okay. What is the nominal rate? The nominal rate was 6%. Okay. And the effective interest rate was what? It was 7 point something there, 7.9. Okay. So 7.9%. All right. All right. So the question is, assuming the effective interest rate was not given, this is how we are going to account for this. So every year we charge interest. Every year. The 6% is the actual interest on the instrument. Sometimes the question can tell you that they can say that the company paid a dividend of this. The dividend is just like an interest because the preference shares will be classified as a debt instrument. So it means that we are paying interest on the what? On the instrument. So the normal interest on the normal interest on the instrument will be 0.06 times the 4 million. That is the normal interest on the instrument. Then this will be the interest. Then you count to the amortization of the transaction cost, which will be 0.04 divided by 4 years, which is the maturity period of the instrument. Assuming we are not giving the effective interest rate, this is how we are going to account for the instrument. But since you are giving effective interest rate, it means that effective interest rate has taken into consideration the normal interest and also the amortization of the transaction cost. Therefore, you should capitalize the transaction cost. So if you capitalize the transaction cost, the net amount, if you calculate your 7% on it, it will take into consideration the normal interest of 6% on the 4 million and also the yearly amortization of the transaction cost. So if you are giving an effective interest rate, yes, Senior.
Yes, sir. Please, where do you get a 0.04 over 4 years?
Oh, is the transaction cost is 1% of the proceed.
Okay.
So is 1% of this one. So you just multiply. So this is what we do. Let's find the fair value of the instruments. So if you are giving the effective interest rate, then you have to amortize the transaction cost and also the discount. All right, let's come here. So we have the nominal value of the instrument, which is 4 million, which is 4. Then you count to the issue cost. Then you can calculate the issue cost as 0.01 times 4 million. And that will give you 0.04. And this will be a subtraction. What are we going to have? Would that be 3.96? Would that be okay? Someone can also calculate the fair value as maybe 99% of the issue cost. Do you agree?
Yeah.
Okay. 99% of the proceed, which is this one, because the issue cost is what? Is 1%. So the remaining one will be 99. This is what we are going to have. Okay. So this will now be carried through amortized cost. What do we mean by amortized cost? At the end of every year, you charge the interest. You are having 3.96 as a debt now. So you charge interest. The interest is going to increase the debt. By the end of the day, you are going to pay part of the debt. So that will reduce it. So we now come here. We have our fair value. So what I will do is, let me just do a table because some people, they are used to the table. Okay, so I will do this one for 2 years. So I will have the amortized cost. Because of the time, that is why we use the table. So you have the years, you have the balance brought down, you have the interest, you have the coupon payment, then you have the balance carried down. Okay, I can also do this one separately. So let's have year 1. The balance brought down, which is the balance at the start, is a 3.96. Okay. So what is our interest? 3.96. The interest rate that we are going to be using will be the 7.9%. The coupon, which is the payment, will be the 6%. Okay. So 7.9% on 3.96. What are we getting?
0.3.
0.3. So what will be the interest that we'll be paying on the loan? The interest on the loan is what? The 6% on 4 million. So 0.3. That'll give us how much? 6%. 0.24. Okay. So this is due an amount that we are paying. Under normal circumstance, if the transaction cost was not capitalized, we will charge our 6% on the 4 million, which will be 0.24. So the interest will increase the 4 million before we pay the coupon at the end of the year. But since we are capitalizing, this is where the difference is. So what will be the balance at the end? So 3.96 plus 0.3 minus 0.2. What are we getting?
4.02.
4.02. Okay. You can see that the normal interest that we're supposed to charge to profit or loss on the instrument is 0.24, isn't it? The normal interest should have been 0.24, but we are charging 0.3. What it means is that the interest is 0.24, and the amortization of the transaction cost will be 0.06. Would that be 0.06? If you add a 3, are we getting 0.3?
Yeah, that's it.
Okay. So you can share it like this. You can go to profit or loss and share it like this. The interest is 0.4, 0.24. The amortization is 0.06. You can share it like that. Fine. Okay. The 0.3 is 7.9% on the 3.96. Okay. So we come to this one. The closing balance will become opening balance for this. So we still charge the 7.9 on the 4.02. But the coupon will still be, the interest that we are going to be paying will still be the 0.4. So what are we going to have? The statement of profit or loss for this company, because they are saying it to do it for 1 year, we are going to have a finance cost of 0.3. Okay, this 0.3 can also be breakdown as the interest on the loan of 0.24 plus the amortization of the transaction cost, which is 0.06. So you can do it like that. Yeah. Let's come to the second year. What will be the effective interest rate? What will be the finance cost on the 4.02?
0.32.
0.32. Okay. Then the balance carried down will be what?
4.1.
4.1.
Yeah.
Okay.
Yeah.
So this one you have, they are asking us to do it for only 1 year. So this is what you are going to have. This is what you are going to have. You can also decide to show this one, the financial liability. You can decide to split it over the current liability and those ones, but don't worry, just put it like this. So this is how you are going to do it. The interest will be taken to profit or loss at the end of every year. The balance carried down, which is the residual value, at the end of every year will be shown as a financial liability. in the statement of the profit or loss. Okay, let's take the second question so that we just end it here. All right. Let's take the question 3. Question 3.
Question 3.
Okay.
On 1st January 2017, Tamale Investment Group TIG issued 10% 200,000 bonds on the domestic debt market. The bonds were sold at a premium of 20% of their nominal value. Transaction costs of 10 million were incurred. The coupon is payable annually in arrears. The bond must be redeemed on 1st January 2020 after 3 years at a discount of 1.33 million approximately. The effective rate of interest is 5% per annum. On March 1, 2017, TIG applied the bond proceeds to subscribe for 12% equity interest in Abiola Technologies, 80 for 128 million, including associated transaction cost of 5 million. 2 months after the subscription, 80 paid dividends worth 25 million to 8 equity shareholders. All these dividends were paid out of 80's retained earnings as at 31st December 2016. TIG made an irreversible decision to account for the investment at fair value through other comprehensive income. Market capitalization of 80 as at 31st December 2017 was 2.5 million required in line with IFRS 9 financial instrument. Explain how the above would be accounted for in the financial statement of TIG for the year ended 31st December 2017.
Okay, thank you. So you can see that this particular question is having what? Both financial liability and what? Financial assets, isn't it? All right. So the first part has to do with the financial liability, and the second part has to do with the financial assets. Although we haven't done financial assets already, we assume that we have done financial assets and solve it on this one before we move on to financial assets next week. All right. Let's now come. The company issued a debentures. The company issued what? Okay, bonds. They issued bonds at a value of what? 200 million. The bonds were sold at a premium of 20% of their nominal value. Transaction cost is 10 million. You see the discount that they are giving you over here. It's not a discount that the company is incurring to what? To sell the bonds. It's a discount that the company is going to enjoy at the end of 3 years. So this discount will not be what? Capitalized. It's not a discount that's relating to what? To the issuance of the what? Of the instruments. It's not something that we are incurring at the transaction date. That is why the first question that we solved, the premium, we ignore the premium because the premium will be enjoyed after 3 years. So we don't do anything to the premium. But if you do the computation very well, you see that at the end of the year, you are redeeming the instrument at 4 million plus the what? The 3 million premium. So it means that the premium is taken into consideration before estimating everything. So what we are going to do for this particular one is we take the face value of 200 million, we add the premium of 20%, then we subtract the transaction cost of 10 million, then we move on. So let's come. That will be question 3, which is the TIG. So let's come to the financial liability. So the first one is we have to look for the financial liability. All right. So we come to the fair value. Let's determine the fair value of the instrument. So the fair value of the instruments will be, the first one will be the nominal value, which is the face value. Okay, which is 200 million. Then we come to the premium. The premium will be added. So 0.2 times what? 200. Am I correct? Am I correct with the premium? The premium is 20% of the nominal value. Is that correct?
Yes, it's 20%.
Okay. So that will give us, is it 40?
Yeah.
Okay. Then we now come to the transaction cost. Transaction cost of 10. So we now be having 230. Okay. So we are giving the effective interest rate. That is why we are capitalizing. But if we are not giving the effective interest rate, it means that the premium will also be amortized over the what? Over the period. Then you charge your normal interest on this one. Then you count the transaction cost. But since we are giving the effective interest rate, it means that we have to capitalize any other cost that is resulting from the issuance. So let's come to the effective, the finance cost, calculation of finance cost for the year. So the finance cost will be calculated as the effective interest rate times the residual value. So what is the effective interest rate here? It is 5%. Why is it 5%? Because the instrument is issued at a premium. The instrument is issued at a premium. So the premium is an income. It's going to be reducing the interest at the end of every year. So you don't have to have effective interest rate that will be higher because the premium is an income. It's going to reduce the interest. So the effective interest rate must be lower. Okay, so let's come to this one. This interest will be 0.05 times the 230. What are we having?
$11.5.
11.5. Okay. So at the end of the year, the company will pay the interest on the what? On the loan. They will pay the actual interest on the loan, which will be what? 10%. So 10% on the 200. That is the interest. They will pay it at the end of the year, which is the coupon, which will be 0.1 times the 200. So this will be 20 Ghana cedi. So let's now find the residual value. That will be 230 plus 11.5 minus 20. What are we having? So that will be 231.5. Is that correct? Or 221.5?
221.5.
Okay. That will be 221.5. So this is the figure that will be shown as financial liability in the statement of profit or loss in the financial position, and this will be shown as profit or loss. So this will go to statement of financial position, and this will now go to profit or loss. This will go to profit or loss. This one will go to profit or loss. All right, let's come to the financial assets. Financial assets. Okay. So the financial asset, what is the question saying? What is the question saying? Okay. They are saying that on 1st March 2017, TIG applied the bond proceeds to subscribe for 12% equity interest in Abiola Technologies for 128 million, including associated transaction costs of 5 million. 2 months after the subscription, AT paid dividends worth 25 million to its equity shareholders. All these dividends were paid out of what? AT's retained earnings balance at 31 December 2016. Okay, TIG made an irreversible decision to account for the investment at fair value through other comprehensive what? Income. Market capitalization of AT as at 31 December 2017 was 2,500. All right. So this is a financial asset through equity instruments. So if you have a financial asset through equity instrument, the classification is only two. It can be through profit or loss or through other comprehensive income. Through other comprehensive income, with the sense that you are not willing to what? To sell the assets right now. You are not willing to sell the financial assets right now. So what we'll do is that it is going to be there for some number of periods. So the transaction cost will also be capitalized. All right. So let's come to the financial assets. Let's find the fair value. The nominal value of the instrument. The nominal value of the instrument is 128 minus 5. That will give us 123. Do we agree with that?
Yeah.
Okay. Then you now have the transaction cost. You capitalize the transaction cost. The transaction cost will be 5 because this is an asset. This is an asset. If you are adding expense to it, it means that it is going to increase it. This is 128. Okay. At the end of every year, the company will pay a dividend. So at the end of every year, they will pay a dividend. Let's look at what the question is saying about the dividends. Okay. They are saying that 2 months after this subscription, AT paid dividends worth 25 million to its equity shareholders. All these dividends were paid out of what? AT's retained earnings balance at 31 December 2016. Is this a dividend for the year? This dividend, is it for the current year 2017? The dividend that they are paying, the 25 million, is it for the current year
No.
or it is for last year, isn't it?
Previous.
This is for the previous year. It means the company cannot have, the TIG cannot have a share of these dividends because this dividend is last year dividend that they are paying this year. So you were not there, you were not part of the shareholders before the last year. So what will happen is that this particular dividend payment will not come here. But if this dividend should be for this year, the company will charge 12%. We find 12% of this 25 million, and that will be the portion of the company's dividends. So we just charge 12% on this one. We don't pro rata dividends. So what we do is that you just find 12% of this. If this dividend should be paid for this particular year. All right. But this is not for this year, we ignore. But if the dividend should be for this year, you charge the 12%. What are you going to get? 12% on that.
3 million.
Okay. So this is how you are going to account for it. You have your 128, you add a 3 million as the interest, which is a finance income. So the dividend will be a finance income to you. Okay, but this particular finance income will go to profit or loss. It's a dividend, but under financial instrument, it is called finance income. So at the end of the year, you will still receive the what? So this is an income and you receive 3 million. So it will still be 128 if the dividend should be this one. Okay, but since the dividend is not for this year, it means that we can't add and subtract. You just leave it like that. Let's come to the classification of the instrument. The instrument is classified through other comprehensive income. The meaning is that for other comprehensive income, we capitalize the transaction cost because the instrument will not be disposed within a year. But at the end of every year, what do? You look for the fair value of the instruments. You look for the fair value of the instruments and compare and see whether there is a fair value gain or a fair value loss. If there's a fair value gain, it will go to other comprehensive income because of the classification of the instrument. If there's a fair value loss, it will still go to other comprehensive income. But the question is, how do we determine the fair value of this particular instrument at the end of the year? Let's come here. The market capitalization of AT as at 31 December was what? 2,500. What do we call market capitalization? What is the meaning of market capitalization?
Value of the company.
Okay, the value or the current value of the company or the current value of the company instrument on the stock exchange market is this one. So the value of their equity on the stock exchange market is 2,500. That is the current value of the company. And this is calculated as the current value multiplied by the number of shares that the company is having. Okay, so this is the total value of the shares, which is 100%. What is our portion of the shares?
12%.
12%. So for us to find the value that is relating to our 12%, what do? We find 12% of this, isn't it? All right. So what you do is you count to this one, then you count to fair value gain or loss. Fair value gain or loss. It depends. Then you come to the fair value at the end. Fair value at the end. So at end, we calculate that, which will be 0.12 times the 2,500. What are we having?
300.
300. Okay. So it means that this has increased by how much? There's a fair value gain of what?
172.
172. So let's come to statement of profit or loss and other comprehensive income for the year. We are going to have a finance cost of 11.5. Then you now have other comprehensive income components. You have a fair value gain of 172. Let's come to statement of financial position. You are going to have a financial asset of 300, which is a fair value. Then you have a financial liability of 221.5. So this is how we are going to account for this particular transaction. Any question before let me save this and share with you?
Sir,
Yes, Senior.
my question is that the transaction costs.
Okay.
How you added a 5 to it, I'm not.
Now this is an asset.
Yes.
Okay. So since it's an asset, if you are recording the transaction cost, it will be you debit the expense, isn't it?
Debit the expense, yes.
And you credit cash. 5 million, 5 million, isn't it? All right.
Yes.
Okay. The question, this is what the question said. The question said that the company applied a bond to subscribe for this one for 128, including associated transaction cost of 5 million. It means that the transaction cost is already part of the 128.
Okay.
So it means that the purchase is for 123 and the transaction cost is 5 million.
Okay.
So they have added that on already. All right. I hope you are okay now.
Oh, I'm okay.
Okay.
It's
All
in the
right.
question. I'm okay.
Okay. All right. So thank you, seniors. Thank you for having you guys. We will continue with financial liability and compound instruments next week, Saturday. All right.
Thank you. All the best.
Okay. So if you don't have any question, they say that they are celebrating Merry Xmas.